Hi, good afternoon, everyone. My name is Eric Anderson. I'm the Chief Technology Officer at SynMax. I want to thank you for taking time out of your afternoon to join us for this quarterly update on our production forecast. Real quick, I want to remind everyone what forecast this is because we do have two different forecasts at SynMax. So this is our long-term production forecast. This is the forecast which is going from the current date out through the end of what the producer guidances can most accurately give us for natural gas production. So just as a reminder, about 50% of natural gas production comes from public companies, 50% comes from private companies. And the producer guidance model has been a fairly successful way of predicting natural gas production historically since 2007 when unconventional wells became much more common. So SynMax, of course, we track rigs and frac crews using daily satellite imagery. And so we believe we have an advantage in this forecast because we are able to view not just the public producers, but also the private producers. So the way that we construct this forecast and the reason why we update it quarterly is because we review all of the quarterly earnings calls and then we review our satellite imagery, namely the DUC activity, rig activity, and frac activity for both public and private producers and make an adjustment between them for our forecast. So that's what we're going to be talking about today. Of course, we still have the short-term forecast, which if you're following that, is currently released for Texas and Louisiana, Haynesville. And that is a very quantitative, well-level production forecast for oil and gas. So that is where we take our direct satellite observations of completions, and then we make assumptions about IP rates and decline curves to build a well-level production forecast. The advantage of that forecast is the fact that it is fully granular. You can take it down to the well level. You can see for every well that's getting completed what the production is for every month in our forecast. But the disadvantage is that we only get about 60 days of predictability out of that. When a frac crew arrives to when a well is turned in line, depending on the region, it's more or less about 60 days. So it is far more granular in detailed forecast. It is a much more quantitative forecast, but is unfortunately a much shorter forecast. And that's why we have the long-term forecast we release quarterly. The second thing I want to talk about before I hand it over to our head of fundamentals, Tony, over here, is kind of the nature of natural gas production forecasts in our industry. I think there is an unfortunate tendency for a lot of analysts and forecast providers to anchor to each other because it creates the ability to take credit when you're right, but when you're wrong, you can just say, well, everybody got it wrong. And one of the differentiating factors at SynMax is we try very hard to develop an independent forecast that is not influenced in any way by other market forecasts that are put out there. And so I think you'll find that our forecast does fall outside of the norm, but we defend our process and we defend the methodology that we're using to come up with it. And that's why we're holding this quarterly meeting so that we can discuss it with you, talk about it in detail. And after I pass it over to Tony, we're going to open it up for Q&A. If you want, you can just type a question into the chat. We'll read them off. You can also deliver your question over the call. Or if you'd rather not that your question be answered in front of the group, you're happy to just email us support@synmax.com. So with that, I'm going to pass it off to Tony to go through our natural gas production forecast. Tony?
Good afternoon, everyone. So with the long-term natural gas production forecast, we use public producer guidance along with the private producer activity adjustment. And then it is updated quarterly without any updates in between. So we keep it strictly quarterly when our earnings reports come out for companies. Moving over into the natural gas market, we saw natural gas prices drop roughly 64% in the rolling front month Henry Hub contract from beginning of November until around March, end of March, middle of March now. And because of that, public producers have started to respond, as you can see from the revision of the long-term forecast for 2023. You can see the revised down, especially in towards the second half of the year. So public producers have responded. We now estimate lower 48 production from the producers on the public side with a private sector activity adjustment to be up 2.8%, whereas in the prior quarter, we had it up 2.4, we had it up 4.1% for 2023. The general deal is $3 per MMBtu is the general all-in breaking level for production. And even Antero Resources stated in their earnings call that under $3 per MMBtu, rig counts will eventually decline 60% in Haynesville. Looking at some of the pricing break-even levels that Antero Resources put out in their quarterly report, it's interesting because Antero Resources is a Northeast producer, but they talk mostly about Haynesville and Henry Hub. But in the Northeast, the break-even levels are lower because they have a lot of NGLs that they can monetize and uplift from. So $2.32 to $3.02 is their general break-even level in the Appalachian region, and $3.06 to $3.77 Henry Hub is the break-even level in the Haynesville region. So obviously right now at close of 2/11 for April, we're well below that, and even with the contango curve, we're still well below that break-even level for many producers, for the great majority of them actually. Well, the other issue is, well, why are we priced below break-even? Well, we're priced there because there's the probability of shut-ins and running out of storage space. And because of that, and also the oil basins are an issue as well, because we'll get into it a little bit later, but the oil basins are showing higher production growth on the natural gas side than the natural gas basins in general, because the oil economics are better. But looking at shut-in prices, an estimation from break-even costs from the producers, at least the pure natural gas producers, from Comstock Resources to Southwestern Energy, for their Haynesville area, they had it anywhere between 76 cents to $1.19 for their break-even level on a variable cost basis. So based on that assumption, below $1.19, let's say, would lead to start leading to the beginning of shut-ins in the Haynesville. If we looked at COVID-19 and adjusted it for the oil, obviously because oil went negative at that time around April 20th, and if you adjusted for that, around $1.50 on the NYMEX is when we started seeing shut-ins back then, and it amounted to about 3 BCF a day when you adjusted for the oil piece that caused gas shut-ins as well. It was actually larger than that. It was 9 BCF a day, but it was really more like 3 when you adjusted it for the oil. In the Northeast, although 284 is listed for break-even for Antero Resources, they don't include the NGL's uplift in it. And including the NGL uplift for most of your Northeast producers, your shut-ins begin at around 90 cents per MMBtu. Interesting thing going on lately in the natural gas forward market. You've seen the June 2023 contract down a lot, obviously, since beginning of the winter, November 2022. But at the same time, on the bottom graph, now there's not a lot of trading days for the bullet June 2025, but you've seen it only down a little bit, and it's fairly heavily contango. 256 versus 392. That was a few days ago when we did these graphs, so it's probably lower than that by now. Looking at the reality, short-term versus long-term, all the gas producers are bullish long-term 2024 and beyond, but obviously it's bearish in the short-term in 2023. EOG Resources expects about 5 BCF a day of LNG coming online in 2024 through 2025. In fact, that's the big reason why EOG Resources has been increasing their gas production. They're one of the very few people doing it right now on a significant basis, especially, even though it may not be in the correct areas in the Utica. You want to increase your production where the LNG projects are coming online. Chesapeake Energy, okay, their macro outlook still very bullish long-term for natural gas, even though they're going to be cutting back on rigs and activity. Antero Resources, we expect natural gas demand to increase materially in 2024 and beyond with the advent of new LNG projects. And Coterra Energy, long-term, we are bullish natural gas prices. So everyone's bullish natural gas in the long term because of the LNG at the Henry Hub, mostly where that's going to be. And the spreads between us and Europe and Asia are still pretty high to bring on more projects. But eventually, of course, that spread will collapse. The reality is, with fundamentals bearish in 2023, high storage levels, high production, and additional LNG demand that isn't here yet, public producers are responding to the short-term realities. So because of that, the production profile has now been lowered for year on year, and also from now to the rest of the year. From now to the rest of the year, the key thing is, even though production is expected to be up 2.8% year on year, that does not mean that production goes up from now to the end of the year. Because if you hold production flat from now to the end of the year, it would actually mean that production would be up 2.8% year on year. It's just because last year was lower and we're catching up to it and all that. So even though we expect the average of 2022 production versus the average of 2023 production to be up 2.8%, the profile in terms of exit to exit from this month of March till December, it should be either flat or maybe slightly higher. And again, we revised it lower. And the key issue is producers in the gas dominant basins, Haynesville, Marcellus, Utica, they're scaling back. Producers in the oil dominant basins, Permian, Eagle Ford, DJ Basin, they continue to expand production due to high oil prices. And again, we adjust the public producer guidance forecast for private producer frac activity. And again, it's updated quarterly. Producer private frac activity in the overall lower 48 has been 40% faster year on year compared to the publics. And however, as we look right now, although you see in the blue lines, the blue line being private fracs crews versus the orange in the public, although we expanded faster and we diverged quite a bit on the privates, they've now come crashing back down lately to be actually the publics are a little bit more than the privates in terms of fracking crews. So that could lead to maybe as we get later towards the year, there could be a little bit lower production than expected, but the issue then becomes in up cycles, the privates respond faster than the publics. And then in the down cycles, the privates will also cut back faster than the publics. And that's an interesting thing that we're seeing there. And again, this is the table of the different companies and then the weightings. So with the publics, the raw would be 1.4, but this includes too many Northeast producers that weight the sample overly to the Northeast. So basin weighting adjustment and then private frac crew adjustment gives you about a 2.8% year on year growth. Moving on to West Texas. West Texas is interesting because it's been growing very quickly, expanded again in March. We have 8.1% year on year, although it was rise down from the prior quarter. And we should expect to see a higher production profile from March until December. It will be interesting when we get into April and May. We've seen, at least we're seeing net prices now for April. I think today it traded at 2 cents while fixed price. There's going to be maintenance on Gulf Coast Express. So it'll be interesting to see what happens in April and May if the production comes back down from there. And we may revise up when the public producers report again. It'd be interesting to see what the Permian producers are saying in terms of the gas side. But based right now, it's pretty aggressive growth in gas production from the Permian producers. As you can see here from Apache, production growth will be driven by oil. So they don't care so much about natural gas, even if gas prices go negative maybe. And Callon Petroleum, strong well performance. Chevron, Permian growth will be a little bit lower in 2023 than in 2022, but Permian grew 9.3% in 2022. So a little bit, is probably about 8%. And then Diamondback, we continue to have well outperformance in addition to efficiency gains from simul-fracking. Simul-fracking's been very successful in the Permian. It's the equivalent success of multi-pad drilling. And so, it's being done with a lot of success in the Permian. And Pioneer, we expect to have quarterly production growth throughout the year in 2023. There are some midstream plant expansions of 1.4 BCF a day in the Permian, and there's not going to be enough pipe to take all that additional gas. So it's going to be very interesting to see how this all comes to a head. And private producer activity has been the fastest relative to the publics in the Permian by about 50%. And again, if you look at the private activity, it exploded in 2022 versus the publics on the fracking. And then now you're starting to see it come back off again. And then the West Texas sample with the publics, the private adjustment, and then the sum of the two. Now, Eagle Ford is interesting because with Silverbow Resources, they've actually diverted 2 of their rigs from the natural gas part of the Eagle Ford to the oil part of the Eagle Ford, and they did it within 2 weeks. It's pretty fast. They also elected to duck 8 Webb County chalk wells because natural gas prices were too low. They're waiting for natural gas prices to go back up so they can do it. Their bogey was over $3 per MMBtu. So, and then also SM Energy continues to increase production due to high oil prices. And even though it's up 3.7% year on year for South Texas production, the profile is expected to have flat natural gas production from March and now until December. And private producer activity has been pretty consistent with public producer activity. And you can see there, it's been vacillating around there, private and public from fracking crews. And then there's the table of the different producers, small downward private adjustment compared to the publics. Now the Northeast is going to be the one region that's going to have lower natural gas production year on year. However, from March until December, it should be a little bit higher. One issue is CNX Resources had a failed well bore that caused their production to be lower than expected for 2023. It's delayed a lot of well completions. So they should catch up to that by the middle of the year, but that's one reason, another hit to Northeast production right there. Chesapeake, they said they will reduce activity in Marcellus due to much lower natural gas prices. EQT said, obviously the largest producer of them all, we see higher cost producers cutting back now. Our production is expected to be flat year on year for 2023. And Range Resources said production will be back halfway to 2023. And you know, the pricing is better in November and December in the Northeast than, especially in December, than the summertime in the Northeast. And Coterra, they expect their production to be down 1% in 2023, and that's from the Northeast side. The only reason why their oil production is expected to be up is because they bought SynMax and they have that oil production in the Permian. And we had to adjust our Northeast production upward from what we had because we were too aggressive on the production declines in the prior quarter for the long-term natural gas production forecast, but we still have production down 0.9% year on year for the Northeast, but production should increase a little bit from now until December due to CNX coming online with more production because they had operational issues and due to better seasonal pricing in Q4 of this year. Publics versus private fracking in the Northeast, it's been fairly consistent and there hasn't been any significant deviation from the two for quite some time. And then that's the table of the different Northeast producers with a small private adjustment downward. Haynesville, Louisiana, Haynesville, Texas. Now we got 2 interesting things going on there because while the economics are getting bad in Haynesville, Louisiana, Haynesville, Texas, Comstock Resources hit the jackpot with the Bossier. They hit 2 wells in the Bossier part of the Haynesville, Texas region that had a 42 million cubic feet a day initial production rate. And it was a pretty good deal for them. And they're completing a 3rd well now in that area in the Bossier that's 12,700 feet lateral. And because of that, Haynesville, Texas is going to grow a lot faster than Haynesville, Louisiana. Plus, Haynesville, Texas is a lot smaller. And Haynesville, Texas is about 5 BCF a day versus about a little under 11.5 BCF a day on Haynesville, Louisiana. So while Haynesville, Louisiana is going to be up 3.4% year on year, however, flat from March until December, Haynesville, Texas is going to be up 12.1% year on year. and it's going to be up from now until the end of December. Again, Antero Resources says that most Haynesville producers will not be able to generate positive free cash flow at current natural gas prices. Decline rates in the Haynesville are also higher at 37% in year one versus 27% in year one for the Appalachia. Chesapeake Energy said we will reduce activity in the Haynesville due to much lower gas prices, and they are also seeing signs of producers coming back in the Haynesville. And Southwestern Energy says we expect to drop rigs in late March, one rig in late March, and then another one in Q2 of this year. Haynesville fracs and rigs. So far on the fracs in Haynesville, this is both Texas and Louisiana, they've been down a little bit year to date, but still up from a year ago. And rigs have been roughly flat year to date so far, and up significantly from a year ago. If these frac crews and rigs don't change, especially the frac crews, it creates potential risk to our forecast in the Haynesville that production would be higher than what we expected. And again, the private fracking activity has been about 20% higher than the public fracking activity. And again, that's the table adjustment. But so overall, the theme is, and we are lower than most production forecasts for this year, especially from now to the end of the year, which is going to be flat to maybe slightly higher overall lower 48 production. The theme is the gas production basins are retrenching or trying to keep the same profile or production level, whereas the oil dominant basins are still growing as long as oil prices at 70 and above. Now, the general thing that I've heard in the conference calls is oil below, WTI below 55, and they start to cut back significantly. And from the fracking companies like Liberty Energy and the largest fracker in the world, Halliburton, they still see the fracking market fully subscribed. And even though their response to all the analyst questions on, oh, what about natural gas prices getting destroyed? Is that going to destroy the fracking crews? Well, their answer was, well, they just shift and go more to either the oil basins or within the basin, they go to oil areas within the basin. They move to oil areas within the basin from natural gas areas within the basin. Yeah. Or they can, if there's someone like Coterra, they can shift it around because they have Coterra has gas production both in the Northeast and the Permian. So they can move.
There's a couple of really good examples of that, by the way. If you pull up Hyperion and you look at the Permian, New Mexico versus Permian, Texas, New Mexico side tends to be the gassier side. And we've seen a pretty precipitous drop in New Mexico, Permian, New Mexico fracs. Let's see if you have it up there. And then in the West Texas side, we're seeing it pull up, which is kind of surprising, right? And I'm always watching the Haynesville, as I'm sure many of our clients are. Every time we get a new batch of satellite photos in, the first place I look is the Haynesville. And like Tony highlighted, so far we haven't seen any significant declines or any declines at all in frac or rig activity in the Haynesville, which is very strange, right? You think with this price environment and the Haynesville being a pure gas play, that you would see an economic reaction to it. It has not shown up yet. What we have seen is what's Tony talking about, is these interplay movements of frac crews moving from the gassier part of a play into the oiler part of a play, like New Mexico into Texas and Eagle Ford into West Texas. So, if I were to highlight one risk to our forecast, I would say that's probably it, right? Our expectations are relatively economic behavior by these Haynesville producers to hit our numbers. And so far it has not materialized. And then on the West Texas side, we're seeing a huge influx of frac crews. And it appears to be because these frac crews were so hard won by producers, right? All the major companies like Liberty and Halliburton have been saying that we are fully subscribed on frac crews, which means that during an excellent price environment, producers are fighting to get control of frac crews. And now that the price environment is less favorable, they're just a bit more reluctant to let go of them than you would otherwise expect. Sorry, Tony.
Oh, yeah, I got is it showing up screen sharing? Pause.
No, you're sharing PowerPoint. You can hear all. Yeah, there it is. Okay, so what are we looking at here? Yeah, we're looking at the New Mexico side where you can see that, there's been much more of a decline on the frac crews than, what we've seen. Is that the most recent data? You have it up to?
March.
Yeah, you've got March 22nd. Yeah, it's pulling back in frac crews. And if you pull up the West Texas side, that's where the crews are reemerging. Although right now, on the year, if you look from Jan 1 till now, we have declined in frac crews. I don't think that's an actual decline. We see this sometimes as frac crews move from one region to the next. There's an efficiency loss. And I think that's what's happening here. All right, any questions? I don't see any questions popping up in the Q&A.
Any questions?
Okay, well, if there's no questions, anything else you want to touch on, Tony?
The other, it's going to be interesting in the Permian because already the gas daily prices or the gas daily fixed price swap is, I think it was offered at minus 65 cents for April. And there's going to be maintenance, granted, obviously, but it's going to be real interesting how ugly it's going to get in the Permian at Waha with this additional gas production that we got in March. So it's probably not going to last. There's probably going to have to be some shut-ins, especially, and it only takes one maintenance event, which you get once a quarter, to really throw a monkey wrench on production and have production shut in for a significant period of time. You could possibly get minus $10 for 1 or 2 day prints at Waha. It's happened before, fairly recently. So while a lot of people say gas production is going to grow like gangbusters in Permian, and it's growing a lot, but the market seems to want to put a little bit of a leash on that right now. And I think the producers know that. So that's why their guidance is not as aggressive as at least in the Permian as they would like. So.
Okay, we have had one question come through, so maybe you can give an answer and then I'll give any additional color. I can read it to you. It says, if you do not see any decline in Haynesville activity, what makes you believe that it will decline in the near term? And what will make you revise it upward?
Well, I don't have it declining. In Haynesville, Louisiana, I have it about flat from now until the end of the year. And then Haynesville, Texas, I have that growing from now to the end of the year because of the Bossier, those huge Bossier wells that were discovered by Comstock. So overall, Haynesville, actually, we have it growing a little bit from now to the end of the year. Even though, yeah, we're seeing the producers are cutting back into Haynesville, but I think from what they're showing on their production numbers, it
oh, Tony, sorry, we got a clarification here. He's saying, sorry, what made you revise it lower from your previous forecast? So that's the change in the.
Oh, because natural gas prices went from basically $7 to $2.50, at least at the time when guidance forecast came out, and that big of a drop. Basically, it's causing producers to scale back the growth big time, to where we're going to see either no growth in production from now to the end of the year or a little bit of growth. And that's why, because from November, when we did this long-term production forecast based on the guidance, prices were at $7 in the front month, and the forward curve in 2023, it wasn't $7. It was lower than $7, but I believe it was still well over $4 at the time. It was a different picture for producers. Now, producers saw these prices come way down when they started reporting earnings in late February, and early March, and their planning therefore changed quite a bit. So that's why it got lowered, because the producers lowered it because they saw much lower prices. So, and the forecast is just based on the public producer guidance, right? So if we were to go back up $2 an MMBTU from now until when producers report again in starting in May or late April and early May, granted that's a real long shot, but if that were to happen, then obviously, producers would revise their production forecast upward, and then we would revise the long-term forecast with what producers are saying, along with the private fracking activity adjustments. That's the reasoning.
And let me add a little color to it. Obviously the forecast needs to be rational. It needs to be based on behavior and economics. And unfortunately, we cannot understand everybody's incentives, and that is the most common source of risk to these forecasts, is the fact that we can see uneconomic behavior longer than you would expect it to. And that's really highlighted in the Haynesville, where we continue to expect frac crews to decline, and yet they do not seem to decline. So I think anyone who is concerned about Haynesville production, this is the value proposition of SynMax. Stay on top of that number. Every time we're pulling out a new batch of satellite images, that should be the first region that you're checking, because that is the biggest risk to gas production, is what happens in the Haynesville right now. Would you agree with that?
Yeah, and keep track of the rigs in the Haynesville, because obviously all the rigs, it's going to be all natural gas, right? It's 95+% natural gas in the Haynesville. So, and in the Northeast too. Well, Northeast not they have more NGLs there, but it's still predominantly natural gas in the Northeast.
Okay, well, if there are no other questions, just a reminder, of course, you have unlimited support and unlimited access to everybody on our team as Hyperion subscribers. Feel free to send us notes or ask any questions you think of later to support@synmax.com. I want to thank everybody for taking the time out of your day to listen to our production forecast update. Hope you found this information valuable, and we'll be doing this again in 3 months after the next batch of producer earnings come out. In the meantime, reach out to us if you have any questions. Thanks a lot.
Thanks, guys.